Well, welcome everyone to another Capital Conversation. I'm Colin Day, CFP, with Brian Pultman, CFP. Brian, thanks again for joining us.
Thank you, Colin. Great to be here today.
Well, we are doing a year-end recap, and 2022, unless you've been under a rock, was a pretty rocky one. So we wanted to talk today about what we saw in 2022, how we communicate with folks when we see the tumultuous waters, and then where we think we might be heading in 2023 and what we're hoping to see in the near future. So it's not all going to be doom and gloom, right? You don't think so? Okay, all right, well, that's good. So let's start here, Brian. So looking back on 2022, what's something you'll remember when it comes to those big stories that affected the market?
Inflation.
Yeah.
There's no question. It's been since the 80s. I remember back in college days when inflation was peaking at 12, 14%. That this is the first time ever most of our clients have ever had to experience any type of inflationary market cycle.
Mm-hmm. I mean, and from an expense perspective, would you say that our clients who were needing funds, because we work with a lot of pre-retirees and retirees, do you think they were withdrawing more to battle against that inflation, or do you think the way that their accounts have been set up or their cash on hand, do you think it was sufficient for them so that they didn't have to feel like they needed to make big withdrawals just because groceries and gas and other things are going up?
Cash flow wise, our clients were in good shape. The key thing was about people that want to make large capital expenditures like a home and or a car.
Yeah.
So in most cases, we try to put off those type of large purchases just because of supply and demand. The markets were disconnected, especially in the used car market. Over the years, you'd be able to buy a used car for a good discount from a new one. Today, used cars are almost like 90% of a new one.
Mm-hmm.
So if people can hold off another year or two until the market stabilizes once again, we encourage them to do that, number one.
Sure. Yeah. And with those large expenditures, like you said, the inflation then has an influence then on the interest rates that we're all seeing. And so mortgages, car loans, as examples, are really inflated from where they were even a year ago.
Correct.
So when you think then, about things we were communicating to clients then in 2022, because as we saw in the market, whether you judge it by the U.S. or the bond market, things were down by double digits. And in a year like that, this is really where financial advisors shine. This is where we try to communicate our message and why we are investing the way that we're investing. So if you think back to last year, and probably where we are still in 2023, what's the message? What's the message you've been telling your clients?
The key message is we want to keep our wealthy clients wealthy. And in markets that we had last year in 2022, it's normal. If you're going to be an equity investor, you have to be prepared to have cycles at this magnitude. On average, the market will drop 10% 3 times per year. So you look at the year, and we finished out 20 to 33% down on the index, depending on what index you're looking at. We're very fortunate that our portfolio team started taking a more defensive approach a year ago in October 21 than in January, March, and July to be more defensive. So year end, our numbers were quite a bit better in terms of losing less, let's just say, than the relative benchmark. But the key thing is to help our clients reach their goals. And right now, we want to let them know we just don't want to sell from the growth bucket. We have enough income and cash to get them through this market cycle.
True. Yeah. And as I've tried to explain to some clients to say, hey, our portfolio management did a pretty good job last year, but it is putting lipstick on a pig when you're still in the negatives. And it's almost impossible unless you're incredibly focused on a very particular market sector to actually see growth and see green numbers as opposed to red on that spreadsheet. So for us, the way that I have been communicating with folks is just making sure that we have your time frame in mind. It could just be as simple as, hey, if you're 50 years old and you're not planning on retirement for another 10, 15 years, and like you said, we're going to have market cycles, recessions happen every 6 to 7 years. We're going to go through many of these before you even retire. And then when you're in retirement, we've got 20 to 30 years. And so we're probably going to go and rinse and repeat, 4 or 5 times.
Exactly.
So we want to make sure that our clients feel like they are having service, because I feel like a broken record a lot of times when I'm telling folks, hey, we understand that we have this time period. We just got to get through it. I know things don't look good now, but things will look rosier later, because that then really raises the question of like, well, what are you doing now? Are you sitting on your hands, Colin? Just let the market have its way with my account? And that's not the truth. That's what our portfolio managers, that's what Joe and Ryan are up to. They're trying to make sure that they are positioning accounts the best way possible for not just in the next 6 months, but even years into the future.
Correct. So the idea there was back in the end of 21 and the beginning of 22 to position us to be more defensive. Mm-hmm. As we went through the year, we decided to take advantage of the losses in the fourth quarter and start capitalizing losses that we can carry forward to help people be more tax efficient in the future. Mm-hmm. So as you mentioned, the key positioning right now is about recovery.
Yeah. And, we're about midway through January. So 2022 in the rearview mirror, looking to 2023. So what are your expectations when we think about maybe more specifically the stock market? Maybe not who's going to win, the Super Bowl in a couple weeks from now.
Right. I mean, look, no one really knows the future short term. Longer term, we're still optimistic. We really feel that the economy will, not go into such a deep recession. That we feel that companies are still doing well. And as we move forward, we want to make sure that people, once again, are averaging in a little bit more in the equities while they're down. Mm-hmm. But then again, with tax-free bonds paying 4.5%, that's not a bad place to be parking some money.
Yep. Yeah. And for those clients that are fearful or just trying to battle inflation, sometimes it's more productive to let the growth bucket, like you explained, that longer term focus, that more aggressive focus on certain accounts, to let that ride. But then being intentional on how we're positioning things that are within our control. And sometimes it is that most basic thing of, hey, if I've got cash in a money market fund that's still paying, 0.25% if you're super lucky, maybe this is a reason enough that we need to start to explore other kinds of cash resources, treasuries. For other folks, it's high yield savings accounts. CDs now are slowly coming up in rates. So never a bad time to have a conversation with your advisor if you have questions about where you should be positioning yourself. So, and we'll wrap up here, Brian. So thinking about 2023. So again, we got 11 and a half months to go. So what are your hopes for the year? And it's a two-parter. So I want your hopes for the year when you think about the market, and then for our clients, people that we serve.
Well, the hopes of the year is that we have a healthy year, number one. Two, that we have the opportunity to communicate more with our clients. I mean, I wish we could talk to everybody every single day, but the reality of it is it's difficult to reach people and mm-hmm. the magnitude of clients that we're blessed with. But the point is, as we go forward, understanding what's most important to them, making sure we have their plans intact, we understand what's most important to them, and let them realize that our financial planning tools take into consideration these types of market cycles. Mm-hmm. And in most cases, a matter of fact, I cannot think of one that even this market pullback has changed the direction of any of our clients' planned retirement or long-term goals.
Great. Well, Brian, thank you again for joining us today. I always appreciate it, and I'm sure our viewers and listeners appreciate it as well.
Thank you, Colin. Have a great day.
All right. Thanks, Brian.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. As always, please remember, investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. Correct Capital Wealth Management is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Correct Capital Wealth Management and its representatives are properly licensed or exempt from licensure. No advice may be rendered by Correct Capital Wealth Management unless a client service agreement is in place.